Hi, Griffin Bridgers here. This is episode 3 of Estate Planning Shorts. One question I often get is whether a beneficiary of a trust can cash out their interest, maybe by selling it to the other trust beneficiaries or selling it back to the trustee. And it's an answer there's no black and white, yes, no type of proposition. There's several layers to it. But most trusts have put in place what's known as a spendthrift clause. That's a term of the trust that keeps any beneficiary from selling their interests to anybody else, whether voluntarily or involuntarily, or even to a creditor. Usually that protects the interests of the beneficiary from creditors, but it has the negative effect of keeping the beneficiary from actually selling their interest in the trust itself. Now, there may be a workaround depending on state law. Most states allow you to do what's known as a disclaimer of your interests in the trust. But there's a certain amount of time in which you have to make that disclaimer, usually 9 months. And the real catch is that you can't accept any benefits from the trust or from anybody else in the meantime if you want to have a valid disclaimer. So if you have an invalid disclaimer, that can pop up in a situation where you accept a purchase price for your interest in the trust. Now, intuitively, it would seem that the only consequence to that would be that you're treated as the owner of that interest and you have gift or income tax consequences. But there's another question that pops up, and that is that under the laws of many states, a disclaimer will circumvent a spendthrift clause unless the disclaimer is not qualified, in which case the disclaimer or the spendthrift clause could kick in to bar that sale of the trust interest. So then you have to go another layer deeper. A lot of states might allow the beneficiaries and trustee to agree to modify a trust, but in doing so, you can't modify the trust in a way that would violate any material purpose that was established by the creator of that trust. And in some states, it's a universal fact or truth that a spendthrift clause in and of itself will be treated as a material purpose of a trust. So given that, it may be even more difficult, even with that disclaimer option, to try to sell an interest to another trust beneficiary or use a trust modification to allow that type of a transaction to occur. Then finally, you could look at a situation where maybe the trust or the share is terminated and the assets are distributed out to the beneficiary, then sold to the other trust beneficiaries. There's a few problems. Once the toothpaste is out of the tube, it's hard to put it back in. So you could possibly sell the property to the beneficiaries outright, but you couldn't really put it back into the trust, at least not in the way that you might anticipate would make sense. And obviously then the beneficiary who gets the distribution and makes the sale may end up selling a lot more than what they anticipated and could have some unanticipated tax consequences there as well. So as you see, there's no hard and fast answer, and there's no solution. It largely depends on the state you're in, the types of assets in the trust, the terms of the trust, and the sky is the limit in terms of the permutations. But either way, if you're a beneficiary and you want to sell your interest, you're going to run into a lot of roadblocks. Thank you for joining me for this episode 3 of Estate Planning Shorts, and I look forward to seeing you in the next one.